Welcome to a new episode of Quest for Twice. Today is July 21st. It has been a while since I made my last episode. The market has declined significantly in this year. Most of it is due to the valuation level has come down. The PE values for most companies have declined significantly. To me, that's not a bad thing because it means that I can buy companies with a lower price. What's more important is to look at the company business performances. With the Q2 earning report season coming up, I'm going to start to look at the companies in my portfolio who recently reported their Q2 earnings. The first one is Kinder Morgan, which reported the earnings yesterday on July 20th. As always, Kinder Morgan delivers very boring earning updates, which is good because in this environment, predictable is a very good thing. So in the latest quarter, the management gave small revisions upwards to its full year EBITDA and DCF, which I updated in this table in red. So instead of 7.2 billion EBITDA forecasted earlier this year, now the forecast is about 5% higher. Kinder Morgan has continuously reduced its net debt. Its 2022 DCF has also been revised up to about $4.9 billion, 5% more than the beginning of the year guidance. Its 2022 capex is also raised slightly to $1.5 billion. So if we put the forward dividend and the 2022 capex together, we get about $4.0 billion. There will be about almost $1 billion surplus DCF left, which can be used to buy back shares. Kinder Morgan actually spent about $270 million in the first half of this year for share buybacks at about $17.09 per share. Its current price is about $17.6 per share, which gives us a 6.3% yield. I think that's a fair price. Overall, Kinder Morgan is making slow and steady progress. Next, I'm going to provide a deep dive in Methode Electronics, which is a Tier 1 auto parts supplier. Its revenue from automobiles segment is about 2/3 of its total revenue. Industrial segment contributes about 27%, and the rest of the revenue contributions comes from interface and medical, as together only 6%. Looking at the geographic revenue contributions, North America revenue contribution is about 55%. Europe and Africa is about a quarter at 26%. And the rest of the 19% comes from Asia. So what does it exactly make? The table on the right shows the key product lines Methode Electronics make, including user interface, LED lighting, power distribution, sensors, digital data related products, and medical products. One of the reasons I like Methode Electronics is because of its very strong financial position. It almost has no debt, and it generated a strong free cash flow in the last several years, $52 million in fiscal year 19, and $95 million in fiscal year 20, and $155 million in fiscal year 21, and $61 million in fiscal year 2022, which ended several months ago. I'm going to get into the reason why the fiscal year 2022 free cash flow is significantly less than the previous 2 years. Another reason I like metal electronics is because of the tailwind from energy transition. The reason being that for internal combustion engines, let's say metal sells $100 of products and components. For hybrid and battery EV, its product and components will actually go up to $120 to $170 for hybrid EV and to $200 and $250 for battery EV. That's because first, there will be additional components required for power distributions from the batteries on board. Additionally, the electric content becomes higher and there will be more opportunities for applications of method products. As a result, the management just issued a 3-year organic sales CAGR target to about 6%. That's driven by more sensors, cameras, and wires in the HEV and the BEV, and as well as battery monitoring, power distributions, and chargers. To back up the aspiration, we can look at the EV sales as a percentage of metals share in the last 3 years, 12% in fiscal year 21 and 17% in fiscal year 22, and with the 20% forecasted in fiscal year 23. In the past, Method is very reliant on General Motors as a key customer. In fiscal year 2016, half of its revenue was from General Motors. That situation has improved, and General Motors accounted for 36% of revenue in 2019 and 23% in fiscal year 2022. And the revenue contributions from other manufacturers have increased significantly, now accounts for about 77%. Ford is the second largest customer with about 9 to 12% of total sales. The graph on the right shows the Method's revenue since 2016. Its revenue jumped from 2017 to 2018, then to 2019 again. That's because of an acquisition Method did in 2018. What's more interesting is look at the gross margin. So before 2020, its gross margin fluctuates between 26 and 27%. It had an increase in fiscal year 2020 to above 27%, but dipped down significantly in 2021 and 2022. In order for us to look closely at the gross margin in the last couple of years, I also provided the gross margin by quarter. That's plotted in the graph at the bottom left. So from June 2020 to July 2021, its gross margin was about 25%. Then the margin dipped down to less than 24% in the last 3 quarters, and hit a very low number of 19% in the most recent quarter. So the margin decline was a result of several factors, including cost inflation, including freight inflation that we have heard so much in the last 2 years after the COVID pandemic started. And also in the most recent quarter, there was a China lockdown near Shanghai that significantly affected the metals production. And also we have already heard a lot about the chips shortage in the automobile industry, and the number of cars manufactured in the last 2 years were significantly below demand. And lastly, there was significant supply chain disruptions due to COVID as well. Because of those temporary reasons, its most recent quarter's gross margin was significantly less than previous quarters. The same forces also explain the gross margin decline in the year 2021 from the margins before the year 2020. The management gave a guidance of fiscal year 2023 earning around $2.9 per share, based on the sales of $1.185 million for the fiscal year. Using that number and the current stock price about $37.35 per share, then we get a PE ratio of 12.9, which is fairly low. And it's very low if we consider the additional factors of potential revenue growth with the energy transition to more electric vehicles as a tailwind. If we look at the value metric of EV over EBITDA, that's about 7.1. That's based on fiscal year 2023 EBITDA around $200 million, assuming gross margin recovers back to 25%, which is about the margin it delivered in 2021 after the onset of the pandemic, but not as high as previous margins before the pandemic. So there is some conservatism building there already. So does the business have a moat? In my opinion, it has a narrow moat based on return of invested capital, which is plotted at the bottom right. So in the 3 years before 2022, its ROIC was at least 13.8%. Quantitatively, that tells me there is some protection against its margin. I believe the reason is the car manufacturers are risk averse due to the large expenses from vehicle recalls. As a result, switching cost is high if they want to use a different component supplier, because then all the products have to go through recertifications. Method has a pretty decent return on invested capital. Then does it make a significant amount of investment? That's answered by the graph at the top right. So in the last 4 fiscal years, it spent about $1.23 billion to deploy its capital. 60% of that is investing in growth, including R&D, capex, and mergers and acquisitions. It also reduced its debt by about $370 million. And spend $140 million for share buybacks and dividend. As I mentioned earlier, now it has almost no debt. So that's another significant amount of free cash flow that can be used to either buy back shares or paying dividend or buying new companies. Now the market valuation level has come down. So what are the threats and opportunities? I think the opportunities are from the EV growth related to the energy transition, and also ease of chip shortage and supply chain disruptions. There is an additional upside from its medical segment, which is only currently 1% of its revenue, because its new product has not been really widely adopted. If that takes off, then there will be a significant revenue contribution as well as profit contribution from that sector. The threats are from a possible recession, during which consumers may buy fewer vehicles and reduce the demand for its products, and also loss of competitiveness, because it's very difficult for me to assess the quality of its product and how easy it is for its competitors to come up with a better quality or lower price products. But at the current valuation level, with the credible growth story ahead, I think it makes a compelling case to have a small position in my portfolio. This concludes the latest episode of Quest for Twice. Until next time, happy investing.